Welcome to this explainer. You know, if you hear the words stock market and immediately picture this chaotic, complicated casino where only Wall Street finance experts win, hey, take a deep breath. You're in the exact right place. Today, we're completely stripping away the jargon, removing the anxiety, and making the stock market totally accessible.
So to kick off our journey to clarity today, we really have to start with the most foundational question of all. What exactly is the stock market? In this explainer, I promise you a completely beginner-friendly breakdown that demystifies the whole thing step by step. To make sure we don't get lost, here's our roadmap for today. We'll start by demystifying the stock market, then cover shares and how they work, the stock exchange ecosystem, what exactly is traded, investing versus trading, and finally, getting started while avoiding those common beginner mistakes. All right, let's jump in. Section 1. Demystifying the stock market. Okay, let's dive into this and build our understanding right from the ground up. At its absolute core, the stock market is simply a system where people buy and sell ownership of companies. But why does it even exist, right? Well, think of it as this brilliant win-win ecosystem. See, companies need money to build new factories, launch new products, or hire employees. Instead of taking out massive, crippling bank loans every single time, they raise money from the public. And in return, everyday investors like you and me give them money and get a genuine chance to grow our wealth alongside the company's success. Section 2. Shares and how they work. So now that we know why the market exists, we need to understand the absolute smallest unit of this massive marketplace. A share, or a stock. And notice the crucial word here, ownership. You aren't just buying digital paper bouncing around on a screen. You're technically buying a tiny piece of a real, breathing, functioning business. And this brilliantly illustrates the concept. Think of a company like a giant, delicious pizza. Try not to get hungry here. That pizza is divided into multiple slices, and each slice represents one share. So buying a slice means you own a tiny part of that pizza, or, in our case, the company. Sure, you might not be the CEO making the big executive decisions, but you are absolutely a technical part owner. Let's put some quick, simple math to this, just to make it concrete. Imagine a small company is worth 1 lakh rupees, and it divides itself into exactly 100 shares. Well, if you buy 10 shares, you own a distinct percentage of that business. If the company performs really well, the value of those shares goes up. Say you bought a share at 100 rupees, and later it grows to 150 rupees. That 50 rupee difference? That's your profit. Actually, some companies even share their direct profits with investors through something called dividends. It's a pretty sweet deal. Section 3. The stock exchange ecosystem. Okay, so we know what shares are, but where exactly do we go to buy these digital slices of pizza? You go to a stock exchange. This is a digital marketplace where people buy and sell shares literally within seconds. Think of it exactly like an online shopping site, kind of like Amazon. But instead of buying shoes or electronics, this specific marketplace is built entirely for buying and selling company ownership. To ground this in reality, the major players in India are the NSE, which is the National Stock Exchange, and the BSE, the Bombay Stock Exchange. In the USA, you've got the famous ones like the NYSE and NASDAQ. Today, these platforms handle millions of transactions entirely digitally, literally in the blink of an eye. Now, if you're sitting there worried about safety, here is some wonderfully reassuring news. In India, the stock market is strictly regulated by SEBI. You can think of SEBI as the ultimate referee of the market. Their entire job is to maintain fair rules and, most importantly, protect investors, especially beginners, from any unfair practices. It's a highly regulated, secure environment designed to keep your hard-earned investments safe from fraud. Section 4. What exactly is traded? Let's move on and see how this builds, because a lot of beginners think it's only individual company stocks out there, but there's actually a whole menu of financial instruments available. First up, we have mutual funds. This is where money is collected from many different investors, and professional managers decide exactly where to invest it. Honestly, this is a fantastic entry point for beginners because the experts handle all the heavy lifting of choosing where the money actually goes. Next, we have ETFs, or exchange-traded funds. These are basically baskets containing multiple stocks, but the entire basket is traded just like a single stock. So instead of agonizing over picking one or two individual companies, ETFs allow you to buy a little piece of dozens or even hundreds of companies all at once, literally with just one click. Then there are bonds. Now, when you buy a bond, you aren't actually buying ownership. Instead, you're giving a loan to a company or a government.
In this scenario, you basically get to act like the bank. They borrow your money, and in exchange, they pay you regular, predictable interest over time. Finally, we have derivatives, which include things like futures and options. Now, I do want to offer a gentle but firm warning here. These are highly advanced, highly risky contracts. Beginners should absolutely avoid them, for sure. Your absolute best path is to focus on simple, long-term stock and mutual fund investing first, way before ever looking at derivatives. Section 5. Investing versus trading. So, the crucial point here, and this is a massive area of confusion for newcomers, is drawing a very clear line between risk and safety. Investing is about a long-term focus, right? Letting your money compound over years to create steady, reliable wealth. Trading, on the other hand, is extremely short-term. It's about jumping in and out of the market to catch fast price movements. Trading moves at a much faster pace, requires a lot more experience, and carries incredibly high risk. For almost everyone starting out, the safety of patient long-term investing is absolutely the way to go. Section 6. Starting and avoiding common mistakes. I really want you to feel incredibly empowered here because entering the market today is so accessible. You just need a few simple things to get started: a PAN card, a regular bank account, an Aadhaar card, and a digital Demat account. That Demat account is simply the digital vault where your shares are securely stored. Today, platforms like Zerodha, Grow, Upstocks, and Angel One make setting this up incredibly easy, right from your smartphone, literally in a matter of minutes. And here is the absolute best part. You do not need huge amounts of money to start. You can begin with as little as 500 or 1,000 rupees. Starting small but being consistent every single month is actually much better and a whole lot more powerful than waiting years to save up a massive lump sum. Remember, investing is about consistency in the market, not trying to perfectly time the market.
However, you definitely need to guard against these common beginner mistakes. First up, investing emotionally. That means panicking when markets naturally fall and getting greedy when they rise. Second, blindly following tips from social media influencers. Just because someone sounds super confident online does not mean they're right about your money. Third, expecting quick magic money. And finally, investing without learning the basics first. Remember, real wealth takes patience, discipline, and long-term thinking.
Which brings us to our final, powerful thought. Understanding money early can genuinely change your future. Once you grasp these basics, the stock market completely stops being this scary unknown and becomes a powerful engine for your financial life. So I'll leave you with this question. If investing even just $500 a month could fundamentally alter the trajectory of your family's future, what's stopping you from opening that account today? Keep learning, and we'll see you in the next explainer.